The IMF recently told the world economy is heading into the worst economic headwinds since World War II. For many, this could be a bad news, but depending on how you look at it, it could also be a very good news. Let's hear what Robert Kiyosaki's last warning on recession is all about. In an interview, Kiyosaki told that this is about as macro as environment as I've ever seen. And I think most people's read on it is probably wrong right now. For him, this recession is similar to the World War II. Here's what he has to say. Why World War II? World War II was a fascinating period because, like COVID, the entire world had basically been stuck at home or been on battlefields. Everyone came back, there was no supply of commodities and goods, global supply chains were broken, and everybody came back and started consuming again. And guess what? Inflation went up to 13% or something, maybe even higher. And that period was fascinating because interest rates went up. And the first thing that happened was the economy went straight back into recession and inflation went negative. Because it was a massive tightening of monetary conditions, you raised the cost of goods on people and didn't raise their salaries enough. The next time we saw anything remotely like this was 1974. Well, the inflation episode we had in the late 70s was driven by demographics. That was the baby boomers entering the workforce at all at the same time. It was the largest demand shock the world had ever seen, and we had a supply shock of this oil crisis of the Arab oil embargo. That's not repeating now. What is actually more similar is 1974. So does it mean we are pretty close to 70s? Kiyosaki responded, yes, and the inflation fell in 1974 afterwards. People are still thinking inflation goes on forever. It did not, and it did not in the 1940s either. Okay, so what's going on here? Why does this phenomenon keep happening? Everyone extrapolates inflation out forever. What actually happens is that consumption falls because we've tightened monetary conditions. So, tightening monetary conditions to ordinary people means the cost of your mortgage has gone up at the fastest pace in history. Over a one-year period, mortgage rates have never been rising this fast. So, any money you borrowed has suddenly got much more expensive. Your wages haven't kept up with the cost of just basic services like food. So you're actually feeling poorer. So you can't consume as much, and you start not consuming other things. People overextended in housing because they rushed into housing in 2020 and 2021, and the rates have gone up from them. All of these things get together would suggest that ISM is going back to 30, which is as it was in 1974, which is a terrifying fall. And it's suggesting that if we're not careful, we could have a very sharp, nasty recession, meaning kind of a negative 5% GDP recession. And everybody's looking around saying, well, what's going to break? When stuff like this happens, the market goes down, something's going to break. We're looking, what bank is it? What hedge funds is it? The actual answer is, it's the economy. The economy has just broken, and the Fed are going to have to pivot. For those who are not familiar, recession means 2 back-to-back quarters of negative growth. Kiyosaki said, to you and me, I think it means a loss of jobs and a loss in your net worth because it's the falling of asset prices that comes with a recession. Is it possible that we are going into a depression? He furthered, depression, I would suggest, is a much longer, more extended period. We're taking probabilities. The reason being is there's one piece of magic, the Fed balance sheet. The Fed balance sheet disguises all bad things because what it does is when they print money, it lowers the purchasing power of the dollar, and most of the central banks at the same time do it. And people always think it's going to be inflation is what leads to. It leads to something much more pernicious and evil, which is the debasement of currency, and what that does, how it manifests itself is all of these scarce assets, equities, real estate, gold, crypto go up a lot. But all they're doing is reflecting the devaluation of the fiat currency itself. So that optically can change everything. Because suddenly all of these things go up. Everybody feels okay and it changes the outcome. People are still worse off generally. But it's a trick. And so, I think that trick gets played again pretty soon. This time, I think the trick which the Europeans are doing now, some states in the US are doing, Japan is doing, India is doing, which is direct transfer payment to individuals. I think it's going to happen at a shocking speed. So, in 1974, we went from everything looks okay to the worst recession since World War II in 4 months. So I think we're going to have a very ugly few months, both economically and for markets. The question is, what comes next? And that's the key point if my base case comes into play, which is the Fed 5-up. He also expounded on the debasement of currency. Kiyosaki said, basement currency works in a simple way. If you're really thirsty and I have a bottle of water, you'll pay anything for it. If you're really thirsty and I've got 5 bottles of water, you're kind of thinking, yeah, I probably need some of that water. I'll buy them all but at a lower price. If I say, here's 1,000,000 bottles of water, you don't want any of it because there's too much water. Now, it has no scarcity. So if you make too much of something, it becomes less valuable. With that in mind, the question is, when does a bull start climbing again? He pointed out the recession in 2000 and 2018. He said, we either go through a scenario like 2000, which was a typical old school recession where equity markets and wound excesses, the bear market was 18 months or so, and then the Fed keep cutting rates, and eventually it stabilizes. But if you look at 2008, which was the next recession, as soon as the Fed used the Fed balance sheet, we pretty much stopped in its tracks really quite quick. After they did that, they cut rates. But the economy cannot take higher rates because everybody's so in debt and everybody's so old. That is the problem. So, if we cannot take higher rates, can we keep doing the same thing? Let's go back to the 1940s now and figure out how bad it was then. This was the very similar setup. The worst supply chain issues, massive inflation, everybody coming back in. But what happened was the economy collapsed. Then, interest rates came down and they stabilized. Because the Fed stabilized them and inflation was running slightly hot 3% and bond yields are about 2%. So real rates, meaning you and the property market, are going to make a lot of money. So negative real rates became very good for assets, and what happened in the 1940s and 50s was a massive economic boom. There was a lot of fiscal stimulus because he had to rebuild after the war and companies were building factories. So if you think of it, companies are going to be rebuilding factories in the United States or in Europe and not in China. So that's going to get some stimulus. Yes, the jobs are not there. It's robots in the factories, but still stimulus for the company. The government will do some stimulus as we've talked about. Interest rates will remain relatively low. Inflation will remain controllable, but a little bit higher than it has been. And what if that sets off is a period of stability and boom? Because there's so much technology, there's a lot of big things happening in the world that could be. So that would be my rosy outcome, and I think that it's still my highest probability that we kind of muddle through this in a way that we don't expect.